Good afternoon, everyone. Thank you for attending our webinar series today. My name is Tyson Mavar, one of the ConocoPhillips focused advisors and retirement specialists here at the Retirement Group. Today we're going to be talking about the ConocoPhillips pension plan, the various pension titles that different employees might fall under, the interest rate impact on lump sum, and the various payout options. We'll give you an update on what happened to the interest rates this quarter and talk about what we've seen to be some of the most important considerations for our clients retiring from ConocoPhillips. So as many of you know, there's a variety of different pension plans. There's actually 8 different titles, as they call them. The 3 that we're going to focus on today are the Cash Balance Plan, Title 2, the Phillips Retirement Income Plan, Title 1, and the Retirement Plan of Conoco, Title 4. The other plans, most of them are defined benefit plans, and the important distinction here is that if you are on a defined benefit plan, or what's also known as a formula-based plan, your pension lump sum is going to have an inverse relationship with interest rates, wherein when interest rates go up, your lump sum goes down, and vice versa. Contrary to the relationship on the defined benefit plans, the Cash Balance Plan, Title 2, which is for anybody who was hired on or after 2003, would be on the cash balance plan for their pension, or somebody who decided to take the option to switch in 2003, which we were not advising our clients do at the time, but many people did for portability and for a variety of other reasons. Your pension plan does not have an inverse relationship with interest rates. In fact, higher interest rates help your pension. It grows at a faster accrual rate, but the lump sum does not change when interest rates change. In fact, the annuity actually changes with a positive correlation to interest rates on the cash balance plan. On the defined benefit plans, your lump sum is going to have an inverse relationship, and it affects people, especially if you've been with the company for several decades. We could see very big changes to your lump sum payout, as well as your key employee supplemental retirement plan if you qualify for this benefit, as a result of changing interest rates every quarter when the company changes these rates. So first we'll talk about Title 4, the Retirement Plan of Conoco. What you need to know here is, and I'll zoom out really quick here so you can see that eligibility requires at least 50 years of age and at least 10 years of service for this plan. Normal retirement age is going to be reached at age 65, and you would have needed to be hired not only before 2003, but you would need to be a Heritage Conoco employee to qualify for this plan. Now, you will still have some age penalties if you retire prior to 65, as well as take your pension prior to age 65. In fact, you can defer the election of your pension. So for example, if you retired at age 50, you could wait 10 years to take your pension and get full pension payout at age 60, 100% of your pension. In fact, there would be very few reasons to defer your pension lump sum, especially past age 60, because you can see you get 100% whether you're 60 or 65. The lump sum, you do have potentially an incentive to wait to take your pension. If interest rates are falling, you could receive more lump sum money, but you're not going to receive more annuity money by deferring your pension past age 60, at least on the retirement plan of Conoco. So you can see here, those are pretty severe age penalties, although for a lot of people, depending on your risk tolerance, you may, especially if you're retiring as early as age 50, you may be considering going back to work somewhere else and not need this money, which means that you may have a higher risk tolerance than somebody who does need that money for income right away, which means you might have a propensity to invest some or all of this money in stocks and potentially have a higher rate of return, certainly a greater risk profile, but a higher rate of return than what the age penalty drop off is as you approach age 60. So it's not obvious which way to go, whether to defer the commencement of your lump sum or to take that money right away. This is something that we help our clients with after they leave the company, especially if they leave the company prior to age 60. The Phillips Retirement Income Plan, Title 1, on the other hand, it still has a normal retirement age of age 65, but you cannot even commence your benefit prior to age 55, although you can retire prior to age 55. So let's look at how this differs. If you were to retire prior to age 55, you're going to have more severe age penalties. You could see somebody who retired, let's say, for example, at age 50, and then waited till age 55 to take your pension, because remember, on the Phillips plan, you can't even take your pension prior to age 55. Your age penalty is going to be 60%. You're only going to walk away with 40% of your pension if you take it as soon as 55 for somebody who retired or left the company before age 55. For somebody who, let's say, retired at age 55, well, your age penalty is only going to be 25%. You're going to walk away with 75% of your pension because you waited to leave the company until at least age 55. The growth rate is also greater for somebody who waited till age 55. You can see that the discount is 5% per year for somebody who left on or after their 55th birthday, and it's closer to about 6% per year for somebody who left prior to age 55. Even more of an incentive potentially for somebody who left before 55 to wait maybe as late as age 65 to take your pension. You can also see somebody who waits till 55 has the benefit of maxing out their pension as early as age 60 to get 100%. Somebody who left prior to age 55 has to wait till 65 to get full pension, and maybe more of an incentive to defer the election of that pension. But there's still some arguments to be made to take that pension, especially if you're taking a lump sum and interest rates are low. There could be an incentive to take that pension, especially if we foresee that they're starting to climb. Or somebody who doesn't need the money, maybe you go back to work somewhere else. You have the luxury of not needing the money and maybe investing that money more aggressively than somebody who does need the money right away. You might be able to produce a higher rate of return than this pension plan is producing for you by leaving it in the plan. So not an obvious decision, but something that we also help folks with. The payout options, while the lump sum has been very popular for a number of years and for a variety of reasons, some because of the inflation risk of the annuity. There's no cost of living adjustment on the annuity, whereas the lump sum, you could invest that money, potentially outpace inflation. The flexibility of the death benefit, you're not as you don't have as much flexibility with how to leave your pension when you take the annuity, whereas with the lump sum, you can have a variety of different death benefit options, more flexibility how to invest the funds, more flexibility on how much you take out and how often you take out of your pension. A lot of reasons people take the lump sum, but there's a number of considerations for the annuity options as well. So we're going to talk about how these different annuity options work and some of the merits of them. The straight life annuity, some people also call this a single life annuity. It's for one individual, you the employee, income stream for the rest of your life only. When you pass away, those benefits stop. This is the highest payout of all the annuity options because there is no death benefit. And this is most commonly for somebody who doesn't have a beneficiary, normally doesn't have a spouse, or maybe their spouse already has their own pension or benefits that can cover them. They don't need to cover their spouse should they suffer an untimely death. And this is a option for a lot of people that typically have a lower risk tolerance, don't like to see fluctuations with their money that they want to make sure that lasts the rest of their life. A variety of reasons people consider this single life annuity. And we've even done some pension max scenarios wherein somebody who does have a survivor will still take the single life annuity potentially and then purchase an insurance policy with a portion of that annuity money to potentially provide a better death benefit than what these joint annuity options could otherwise provide for their spouse or for their joint annuitant. The joint survivor annuity option has a lot of flexibility in how much you are giving as a death benefit to typically what's going to be your spouse, your joint annuitant. Now, the age of your spouse plays into how much you and they receive on this. The younger your spouse is, the less money they are going to get because the life expectancy is going to be longer, what we call the joint life expectancy of two people, you and your spouse, is going to be longer, so they're going to discount this more. They're also going to discount it more depending on how high this percentage you choose. So for example, if you choose the 100% joint survivor option, your spouse or your joint annuitant is going to receive the exact same amount as you received during your lifetime. They're not going to get a pay decrease past your lifetime if they outlive you. This is not for free though. This costs you in that you are going to receive a lower monthly payout during your lifetime in order to offer a better death benefit, if you will, to your spouse or to your joint annuitant. So a little bit of flexibility here. This is important for differing circumstances. You may have a spouse that is much younger than you. You may have a spouse that's older than you. You may have a spouse that has a better pension than you, a worse pension than you, no pension. There's a lot of factors that will play into how we recommend taking this joint annuity option if you choose not to take the lump sum, of course, because there's certainly a death benefit with that. But there's a lot of folks that like the merits of a guaranteed lifetime income stream, guaranteed, of course, by the full faith and credit of your company, ConocoPhillips. And this could be a great option depending on your circumstances, depending on your risk tolerance, some other things that we factor in when we go through this retirement cash flow analysis that, again, we will do for you on a complimentary basis if you're interested in having us do this for you. Even if you're not a client yet, we're happy to run these numbers for you to shed some light on what might be a better pension option for you. The lump sum, very popular, especially for folks that aren't scared of taking risks with their money, that maybe have managed their investments over the years or have built some familiarity with investing money, which most people do through their 401k at least. The lump sum could be an attractive option based on the flexibility that it offers you on how to invest the funds, the flexibility on how to distribute the funds, the flexibility on how to leave those funds if you don't spend all the money. I would say that's the number one reason when I ask people why they're leaning toward the lump sum, that they say is because they'd rather leave the money to their family than to the company. But recently we've been hearing more concerns about inflation, which is a risk to the annuity given that it doesn't have a cost of living adjustment. There's more potentially some tax benefits to the lump sum. For instance, if you don't need the money right away, maybe you're going back to work or you have other sources of funds, you might want to invest that capital and defer taxes on that money. Whereas if you took the annuity right away, you're going to be taxed on income that you might not otherwise need. The lump sum allows you to continue deferring taxes and also give you more flexible to manage your tax bracket in retirement, to turn up and down the faucet, if you will, given what your income needs are and also what your tax bracket is. Especially if you're employing a Roth conversion strategy, that could give you more flexibility to do that rather than having the forced income that comes with the annuity option, similar to what Social Security does for you when you start your Social Security benefit. So when you take this lump sum, you can roll it over to a traditional IRA, continue deferring taxes on it. You can roll it over to your 401k if you decided that's the best place for your money. That's certainly a possibility. You do not have to take your lump sum right away. Like we mentioned, there could be reasons to defer the election, whether it's because you still have age penalties or because interest rates are falling and you want to watch that lump sum grow on a guaranteed basis. And the way that we manage that here at our company, we use both Schwab and Fidelity as custodians. You get to pick your custodian if you work for us. We would do a direct rollover of the lump sum pension from the pension plan into either Schwab or Fidelity, typically a traditional IRA, but you can roll a portion of that into a Roth IRA if it made tax sense, and we would certainly want to discuss that with you. Now, if you are what the IRS considers a highly compensated employee, you may also have something called a Key Employee Supplemental Retirement Plan, or KESRP for short. This is something that you will see in Fidelity when you run your pension projections, and it's going to be a portion of your pension that you cannot defer taxes on. You can't roll over. You have to take this as ordinary income the year in which you retire, or shortly after at least the year in which you retire. And this also, if you have one of these Key Employee Supplemental Retirement Plans, might be a reason to pick a different retirement date in order to defer income and defer taxes so that you don't have too much income in any one given year, the year that you retire in most cases. There's also some tax considerations to waiting to roll over your 401k if you have some highly appreciated ConocoPhillips or Phillips 66 stock, in order to take advantage of a tax strategy known as NUA, or net unrealized appreciation. These are all things that we talk about with folks to make sure that you didn't avoid a consideration that could save you tens, if not hundreds of thousands of dollars in taxes throughout your retirement. So tax play a big role in the decisions on the timing, not only of your retirement, but also the rollover of both your pension and 401k. Now, we get a question quite often that why, when interest rates go up, does my lump sum on my defined benefit pension plan go down? And the easiest way I've found over the years to explain this is because it's like a mortgage. It's a present value calculation that could be likened to a mortgage, wherein when your annuity is fixed, like it is with a defined benefit pension plan, just like it would be if your budget was fixed on going to buy a house. If you have $1,520 that you can afford to buy a house and interest rates are at 4.5% for a 30-year fixed, the bank might tell you you can afford to buy a $300,000 home. Whereas if interest rates were 6%, you still have the same $1,520 a month you can afford on a 30-year fixed. The bank is going to tell you that you can afford less of a home, in this case, $254,000 home. So when interest rates went up, the lump sum that you could afford to borrow went down. Same as present value calculation on a pension. When interest rates go up, the company effectively is figuring that you could earn more money on that lump sum, so they don't have to give you as much to create the same income stream when those interest rates are higher. So that's reasonable, I would say, analogy for how interest rates affect the lump sum on just the defined benefit pension plans, not the cash balance plan, wherein when interest rates go up, your pension will actually grow faster, but it doesn't have an immediate impact on the lump sum payout. So last but not least, let's talk about the interest rates. Interest rates change quarterly at ConocoPhillips that affect the lump sum. They also affect plans differently. For example, there's an interest rate that we track called the PBGC rate that affects the Heritage plan for Heritage Conoco employees, but doesn't affect Phillips employees, doesn't affect Burlington employees, doesn't affect cash folks that are on the cash balance plan. These rates affect most employees, though. We see the first, second, and third segment rate that are related to corporate bond interest rates, short, intermediate, and long-term corporate bond interest rates, respectively. For September, all of those interest rates went down to quite a large extent. The second segment interest rate carries the most weight in this calculation, and that interest rate went down close to 0.5%. What that means, for reference, is roughly a 5% increase to lump sums at the turn of the quarter, at least based on the second segment rate. The first and third segment rate don't carry as much weight in the calculation, but look at the first segment rate. That went down almost a full percent. The third segment rate went down about 0.25%. So depending on your age, the younger you are, the more severe of an impact these interest rates have on your pension. But for somebody who's age 60, we expect about a 5% increase in lump sums when interest rates drop by 0.5%. And for somebody who's younger than 60, you might see closer to a 6, 7, 8% increase in your lump sum as a result of these changing interest rates. Pretty big to use the 30-year interest rate, 30-year Treasury interest rate for 2000 through 2008 for Heritage Phillips folks. And you're also going to use the Treasury rate prior to 2000 for Phillips folks. For Heritage Conoco folks, the difference is you're going to use the PBGC interest rate for years prior to the year 2000, which is a lower interest rate and results in higher lump sum payouts for most Conoco folks compared to Phillips employees who have all the same statistics of years of service, salary, and some of the other important factors that go into the lump sum pension formula. So the 30-year Treasury also went down, not quite as much as the second segment rate went down, but we are expecting increases in the first quarter to lump sums for all defined benefit pension plans, which would be, for most of the people that I work with, Heritage Conoco, Heritage Phillips, Heritage Burlington employees on the defined benefit plans. You can see at the top row here, September 2024 equals quarter 1 2025. What that means is that the entire first quarter lump sum payouts is based on September interest rates. The significance of that is that we have a crystal ball in which we can tell what direction interest rates are going, and as a result we can pick a good time to retire, or more importantly pick a good time to take our pension, because we know what direction our pension's going and we can avoid losses in our pension if interest rates are going down. However, if interest rates are going up, we can avoid losing money on our lump sum going down. If interest rates are going down, we may want to consider deferring the election of our pension. We may want to consider deferring our retirement date. There's a lot of considerations related to these interest rates, as well as the timing of both our retirement and our commencement of our pension plan when leaving ConocoPhillips. And you can see interest rates went up throughout the last couple of years. They were really, really low in 2020 and 2021, and they've come up in the last couple of years, but we still see quite a few of our clients taking the lump sum, even though interest rates are higher and lump sum payouts are lower, in part because fixed income investments are now paying more, and in part just because the lump sum works out for a lot of people better, usually because of the flexibility that it offers. So, one statistic we show on all of our webinar series, 74% of Americans over the age of 50 do not have a written plan for their retirement. This is a statistic we saw several years ago. It's astonishing. It's unacceptable in our opinion as financial advisors, because there's just no reason not to when a number of advisory firms will run one of these plans for you for free, including ours. What this does, it's a retirement cash flow analysis that projects your money out in the future. We give you a probability of success of retirement. We'll encourage you to potentially work longer if we think you'll need to, maybe save more now, maybe change how you're saving in the 401k, whether you're doing all pre-tax, maybe a portion to after-tax or Roth in your 401k. We'll compare different pension distribution options, lump sum versus maybe one or two of the different annuity options. We'll talk to you about the tax efficiencies of different strategies such as Roth conversions, net unrealized appreciation if you have some ConocoPhillips or Phillips 66 stock in your 401k. Those are very powerful strategies for most people that we meet with who didn't sell all their stock yet from the company. And we'll talk to you about our company to see if it might be a good fit to work with us should you choose to work with an advisory firm when you leave the company. And then we'll also talk to you about ways that you might be able to do a test run of our services prior to retiring, have us manage a small portion of your money to see if it's a good fit and to make sure that we performed well, we gave you good advice along the way with a smaller amount of money than potentially your entire life savings. So let us know if you have interest in having us run that cash flow analysis, or if you just have some questions related to your benefits plans. You can email us or call us. I'll give you a way to do that in just a moment. And here's a way to keep up to speed with these webinars that we are publishing, some of them specific to the ConocoPhillips retirement options, and some of them generic to retirement planning. And if you'd like to reach out to us for any reason at all, email us at info@theretirementgroup.com. You can call us at 800-900-5867. You can even schedule a meeting with myself or one of my colleagues who understands the ConocoPhillips benefits plans by using this QR code here. And again, here's that QR code for the LinkedIn page if you're not following us already on LinkedIn, as that's that place, and YouTube is where we publish a lot of these webinars related to the ConocoPhillips retirement strategy. So with that, we're going to wrap it up today. Thank you everybody for joining our webinar series. Everybody have a good, safe rest of your week. We hope to talk to you all very soon. Thanks again.